Relative value analysis, which is the use of price multiples, is the most common form of valuation used in practice. If not done properly, however, it can lead to poor investment decisions. In this session, we'll discuss a four-step process to ensure that your relative value analysis reflects the fundamentals of the company being analyzed and those of the peer group being used for comparison. Each price multiple has a numerator and a denominator. In the numerator is a measure of what we're paying for the asset. In most cases, this is either the market value or price of the company's stock or the enterprise value, which, as the name implies, reflects the entire value of the firm. In the denominator is what we're getting in return for our investment, whether that be revenues, some measure of earnings or cash flow, or the book value of the company. As I mentioned at the outset, price multiples represent the most common method used to value a company. In fact, this approach accounts for almost 85% of what passes for valuation. With relative value, we compare the price multiple for the company being analyzed to the multiple of other similar companies. The idea being that similar firms should trade at similar values. In economics, this is what we call the law of one price. The process of conducting a relative valuation is fairly straightforward. We begin by identifying companies that are similar to the one we're analyzing and obtain their market values. Now, unfortunately, we can't compare the market price of one company to another. For that reason, we next convert the market values into standardized price multiples like PE and enterprise value to EBITDA. With a price multiple, we can now compare the subject company to the group of peers, controlling for any differences among the companies being compared. You can think of this as akin to the process used to determine the value of a piece of real estate. The appraiser starts by finding other properties in the area that recently sold and then adjusts the sales price for differences in square footage, age of the property, amenities, and so forth. Unlike in real estate, however, this third step is where most investors get lazy. They simply apply the average or median multiple for the peer group to the company being analyzed. This is problematic since it assumes that the fundamentals of the company are the same as the peer group. That is rarely the case. Provided here is a summary of the relative value process. Again, we start with identifying comparable firms. I'd note that the farther afield you go in selecting comparable companies, the less likely it is that you can make meaningful comparisons. Next, we select the multiple that will be used. When selecting the multiple, look to see what other investors are using by reviewing a few street reports. Ideally, the multiple should reflect the fundamental characteristics of the company being analyzed. Before comparing the company to its peer group, we need to adjust for differences between the subject company and the peer group being used. With the adjustments made, we can then determine on an apples-to-apples basis if the company is attractively valued. On the next few slides, I'll outline a four-step approach developed by Aswath Damodaran to ensure that a relative value analysis is rigorous, and importantly, that we make the necessary adjustments for differences in the characteristics of the company and the peer group used in the analysis. We begin by making sure that the price multiples are consistently defined. By that, I simply mean that if the numerator is an equity value, like price per share, then the denominator must also be an equity value, like earnings per share. If not, companies that take on debt are going to look deceptively cheap because interest expense is going to affect the numerator. Similarly, if the numerator is an enterprise value, then the denominator must be something like sales, EBITDA, or operating income that is available to all capital providers. As an example, we'd want to use enterprise value to sales instead of price to sales to ensure that the multiple is consistently defined. The second step is to describe the multiple. By that, I simply mean having an understanding of what represents a typical multiple, what's high, and of course, what's low. Importantly, we also need to have an understanding of how those figures may be biased by the sample of companies that are being used or any outliers that may exist within that sample. The third step is to analyze the multiple. What we're trying to do here is to look at the fundamental variables that are driving the multiple. Remember, fundamentals is just a fancy term for the cash flow, growth, and risk characteristics of the company. With an understanding of the fundamentals, we can apply the multiple in step 4. In doing so, we need to adjust for any differences in the fundamentals before comparing the company to its peer group. It's only through these adjustments that we will be able to determine with some degree of confidence that the company is overvalued, undervalued, or fairly valued relative to the peer group. Over the next few slides, I'm going to apply Damodaran's 4-step process to the most common multiple, which of course is the PE ratio. We define the PE multiple as the market price per share divided by earnings per share. That measure of earnings used can either be trailing earnings, where we look back and see what the earnings have been over the past 12 months, or forward earnings, where we estimate what earnings are likely to be at some point in the future. Because the market is a discounting mechanism, our preference is to use forward earnings whenever possible. The next step is to describe the multiple. In other words, we want to understand what is a typical PE ratio for a company in the United States. On this chart, I've included the trailing and forward PE ratios for all U.S. firms using data from Value Line. I've done that to make a basic observation. Oftentimes, investors will look at the average multiple. This is a problem for 2 reasons. First, the distribution is not symmetrical in nature. It is skewed to the left, given that PE ratios start at 0 and have no cap. And second, the average will be impacted by outliers included in the sample. To see this, let's look at the statistical parameters of the sample. There are a few things that I want to draw your attention to in the process. First, note the number of firms that we lose in the sample as we compute the current PE ratio. These are firms with negative earnings. We lose even more companies as we go to a forward PE because we need analyst estimates of expected earnings per share to compute this variable. Any firms not followed by analysts will not have a forward PE. In fact, you can see here that we lose nearly 60% of companies in the sample. Not only does this mean that the companies can't be sampled, but there is a bias in the sample because we're losing the smallest and perhaps riskiest companies in the group. Finally, note how the means are biased by outliers. In the case of the trailing PE ratio, the mean is almost twice the median. For this reason, we'll want to default to the median multiple when conducting a relative value analysis. The next step is to analyze the multiple. Here, we're trying to understand the fundamental drivers behind the multiple. To do so, we link the multiple to the DCF model we discussed earlier. The simplest way of doing this is to assume that the company is mature and use the traditional Gordon growth model, which is what we used for the terminal value when calculating the intrinsic value of Facebook. Focusing on the forward or leading PE, we see that the fundamental drivers of the ratio are the expected growth rate in earnings, the riskiness of the security as measured by the cost of equity, and the efficiency with which the firm generates growth, which is measured by how much the firm can afford to pay out to shareholders in the form of a dividend. When we looked at the three fundamental drivers of the PE ratio on the last slide, I made the simplifying assumption that the company being analyzed was mature. That's certainly not a requirement. Here we see that the same fundamentals drive the PE ratio for a growth company as well. The only thing that we need to do is to differentiate between the rates used for the high growth period and the normal growth period. So we now know what we're looking for as an investor. We're looking for a company with a low PE ratio, indicating that it is cheap, with high expected earnings growth, low risk, and a high return on equity. In other words, it's cheap without any apparent reason for being so. When you think about it, this four-step process gives us a means of differentiating between stocks that are cheap and an attractive buying opportunity from those that are cheap for a reason. While this process is effective, I should note that a lot of what we do as investors is say no, meaning that to find perfect stocks like the one described here, we have to wade through hundreds of stocks that have a low multiple for a good reason. With an understanding of the fundamental drivers of the PE ratio, we can apply this knowledge in one of two ways. The first is to make direct comparisons of the PE of the subject company to that of the peer group, adjusting for any differences in the fundamental drivers. The second approach involves applying statistical analysis to specifically control for differences in the companies being compared. Regardless of which approach you adopt, this is a means of making more informed investment decisions. Let's take a look at a couple of examples. In this first example, we have an excerpt from an equity research report on the beverage sector where the analyst asserts that Andre Wines and Hansen Natural are undervalued. The justification for this assertion is that the companies trade at a low PE ratio relative to the peer group. Andre Wines and Hansen Natural certainly do look cheap, meaning that they're trading at a PE multiple that is much lower than that of the other companies in the beverage sector. The question is, do the company's fundamentals justify that lower multiple? In other words, are they cheap for a reason? To answer that question, I've added two of the fundamental drivers of the PE ratio. Those are earnings growth and risk as captured by standard deviation. What we see is that while Andre Wines has one of the lowest PE ratios, it also has the lowest expected growth rate in the group, which may explain the low PE ratio. That's not the case for Hansen Natural. The company has one of the higher growth rates in the sector at 17%. But what we see is that it has a very high level of risk as reflected in the standard deviation of 63%. Again, the question becomes, is the higher level of risk the reason the company is trading at a low multiple? From this example, it's clear that not all firms with low PE ratios are undervalued. The multiple may be justified if the company has either low growth or high risk. In this next example, we explore price multiples in the telecom sector. Specifically, we're asked to determine if Telebras's low multiple relative to its peer group is justified. Let's take a look. Provided here are the PE multiples and expected growth rates for the companies in the telecom sector. Since the list includes some emerging market firms, they may be exposed to more risk, whether that be political risk, economic risk, or inflation risk, which should be accounted for in our analysis. In the case of Telebras, the company certainly has a low PE ratio at 8.9 times. The question is, does the growth profile of the company and/or the country risk justify the lower multiple? We can use statistical techniques to answer that question. Specifically, we can run a regression analysis with the PE ratio being the dependent variable y and growth as one of the independent variables x1, We'd also want to include a second independent variable for the country of domicile, which we'll call X2. In this case, a dummy variable could be used to indicate if the company is in an emerging market or not. The output of the regression is provided here. We see that the t-stat for each variable is robust, so we can use the coefficients for a predicted PE model. If we drop in the information for Telebras, including their growth rate of 7.5% and the fact that they are in an emerging market, we'd get a predicted PE of 8.3 times. So despite having a low multiple, the company appears to be fairly valued, maybe even slightly overvalued at 8.9 times, when explicitly accounting for both growth and risk. Here is a summary of the fundamental drivers of the most commonly used price multiples. We'll dig into some of these multiples in later slides. The reason that I've included it here is that I wanted to demonstrate that while each multiple has 3 to 5 fundamental drivers, there is one that stands above the rest. We call that factor the companion variable. For the PE ratio, the companion variable is the growth rate in earnings. Whereas for a multiple like price to book, we'd focus most heavily on return on equity. Let me give you a simple example. Recently, the students in the Babson College Fund had been looking at a foreign bank because unlike U.S. banks, which have been strong performers, a lot of the European banks are still trading at financial crisis multiples. As part of their analysis, they noted that German banks were very cheap, but they hadn't selected one because those banks also have very low returns on equity. In other words, they are cheap for a reason in their. Before closing out this session, I'd like to take a look at the enterprise value to EBITDA multiple. While the PE ratio is unquestionably the most commonly used valuation method, a thorough relative value analysis should integrate multiple methods, including enterprise value to EBITDA. The EBITDA multiple has a number of advantages over the PE ratio. As we'll see on the next few slides, it has the same fundamental drivers as a DCF-derived valuation. In addition, it standardizes companies with different depreciation methods, interest payments, and tax rates. As a result, a company with a lot of debt that would look deceptively cheap on a PE basis will look fully valued or even expensive on an enterprise value to EBITDA basis. Let's delve into the fundamentals that determine EBITDA multiples. To do so, we'll return to the free cash flow valuation method used with Disney. Just as with the PE ratio, I'm going to keep things simple by using a stable growth model where forecasted free cash flow is divided by the spread between the company's cost of capital and their long-term growth rate. In this case, free cash flow is defined as after-tax EBITDA plus the depreciation tax shield minus the combination of CapEx and changes in working capital. By dividing both sides of the equation by EBITDA, we see the fundamental drivers of enterprise value to EBITDA are operating income growth, the company's tax rate, reinvestment rate, and their cost of capital. Specifically, a lower growth rate, higher tax rate, higher reinvestment rate, or a higher cost of capital would lead to a lower EBITDA multiple. In this last example, we're going to look at an analyst upgrade of Ryder Systems to a buy rating. In the report, the analyst cited valuation as the reason for upgrade, noting the company's EBITDA multiple. Let's take a look. One of the advantages of using the enterprise value to EBITDA multiple is that it forces us to explicitly consider the company's reinvestment rate, which is one of the fundamental drivers of the multiple. Trucking companies have fleets that they replace every few years. Thus, the capital expenditures for these firms are often lumpy, with a year of very heavy CapEx followed by a few years of almost no CapEx. In this case, Ryder looked cheap because it had the oldest fleet in the group. As it turned out, 2 weeks after the upgrade, the company announced that it would be taking on significant debt to finance an entirely new fleet. If the analyst had accounted for the age of the fleet and the impending upgrade cycle, the stock would not have looked nearly as cheap. An alternative is to use operating profit rather than EBITDA as our basis for valuation. With a little bit of algebra, we can derive the fundamental drivers of enterprise value to EBIT, which are growth in operating income, the company's tax rate, return on invested capital, and the cost of capital. Remember, we've discussed that growth can either create or destroy value. To create value, the return on invested capital must exceed the cost of capital. So, as you see here, the enterprise value to EBIT multiple explicitly accounts for the positive spread that we're looking for. We can use the fundamental drivers to determine an appropriate multiple for a company. As an example, let's assume that we're analyzing a company growing at 5% per year and generating a 15% return on invested capital. If the company has a tax rate of 30% and a cost of capital of 9, we'd expect that company to trade at 11 to 12 times operating profit. Hopefully this review of Damodaran's 4-step process for conducting a relative value analysis has been helpful. As I noted, it will make your relative value analysis much more rigorous and ensure that any differences between the fundamentals of the company and its peer group are properly reflected.